Now, as always, we like to start off with, all right, where is the general sense of current flows, current volumes? So product demand for last week was at 14.92, this week at 14.43. So again, we're not breaching that 4-week rolling average. We're not getting above 15 million. We're likely between that 4.5, 4.6, and that's where we're going to hold. And you can see it's disappointing in comparison to 2022. We're not getting any of that real growth. And we do see more slowdown. The slowdown won't be as aggressive as we saw in 22. Instead, it'll be a bit better than 22, a bit better than 2020, but again, still below where we were in 2021, and obviously well below what has been deemed quote unquote normal, because we just don't have the demand on trucking, we don't have the demand in shipping, and we clearly, as we've been saying, don't have the demand on the gasoline side, given pricing, which continues to go up, another kind of tailwind for inflation and realistically pressure for the underlying consumer. So now when we pivot to distillate, we had a small build of 300,000 barrels. The build should be way more. As you can see, the pace of builds is massively disappointing, which is a big problem as we go into the winter months, because again, could we get a warm winter? Sure. But it's not good to rely on that when you're looking at where we sit, because things can go upside down very quickly, especially when you look at Pad 1 being the main driver behind this, being down 15.4 million barrels versus the 5-year. And then imports continue to trend a bit higher, increase 64,000 barrels a day, with most of that being in Pad 1 and Pad 5. And it's going to come down to that competition. So you did get a bit of a slowdown in European buying, which again opened up the opportunity for flows into the U.S. because the U.S. is going to compete with Europe off of this Atlantic loop, this Atlantic basin, because we do have that, obviously the crack spreads, the pricing, it supports more flows specifically into Pad 1. Then you look at the crack spreads, it's come down a bit, but again, it's still at a very high level. It's going to support additional runs. Trying to secure those medium to heavier barrels is the problem, and that's where we're seeing some of this disconnect between where the market is and the different barrels out there, because there is that shortfall on the medium heavy, which is going to keep that bid and that support within the diesel side or the heavier side of the barrel and that crack spread, which is why you're seeing more exports from China, you're seeing more exports from India, because they're going to try to now take advantage of what we're seeing. Obviously, it's not going to impact the U.S. to the same degree, but it will impact Asia because it's still pricing in a very strong very strong crack, very strong diesel pricing, and that's where we're going to see some of those flows. Now, when we look at distillate in the U.S., looking at Pad 1, bumping along just above 2022, but that is not a good year to be compared to. Obviously, we had the benefit of a warm winter, but did we get lucky again? And that's going to be that unknown as we start getting into the fall months. Pad 3 trending a little bit lower. Exports are starting to slow. We did get a big spike in exports, not last week, the week before. Some of it came from Pad 1, some of it came from Pad 3. Some of that buying has slowed a bit, so that should put a little bit more into Pad 3 as they try to balance out in terms of where exports are, where refining run rates are. Run rates have gone up a bit. We've seen a bit more production of distillate, which again will show up in this as we go through. But if we get a hurricane, we don't have a ton of comfort, or a ton of cushion here. So that hurricane, which typically, like the running joke is, you buy the rumor of the hurricane and then sell landfall from a crude perspective. And then on a landing perspective, you flip. And so you buy crude, sell crude on landfall, and then buy diesel or gasoline, and then sell when they start to come back online. Because of that, again, trying to play both sides of the weather card when you're looking at the cycles of hurricanes. As we've been saying, demand is going to stay well below the 5-year average. It dipped just below. It'll bounce back up. But again, we're still going to stay at this lower end. And the problem that we're seeing, some of that buying was actually pulled forward, because you did get a little bit of a recovery in some of the trucking, some of the data. it's not that we saw a huge surge in activity. It's just that people are taking advantage of cheaper rates, lower pricing, and that pulled forward some back to school, some Halloween through Christmas ordering. And we see things actually getting a bit worse, because you can see here that typically demand starts to really run up into the end of August. And we think some of that was pulled forward a bit, and you're not going to get the same run up. So demand is actually going to fall a bit more flat or flatter than where it normally starts to get some of that love as we get into the end of August. And here's where, again, you saw some of that spike, you saw some of that increase, and then you've seen it drop back off. Now, it'll balance out. One of the things that we've been saying is, looking at this data, things are kind of holding in and holding this line, which it's not a great line, but it's just what we have. And that's why we don't see a collapse in demand, but we also don't see a meaningful increase either. And that's going to be one of the bigger headwinds as we get some additional slowdowns on the rail side. So again, total carloads down 3%. Forest products, grains continues to be the headwind, especially when you look year on year. But motor vehicles still going to stay strong. Petroleum products going to stay strong. Intermodal slowing further, still remaining the headwind. And again, because we're not moving that much throughout the U.S., because we just don't have the demand economics. What's coming into the U.S. continues to be low. Yes, it looks good in comparison to last year, because last year things started to really drop off. But again, you're looking at vessels waiting. You're still not getting this huge surge. It's the surge is gone, and now we're kind of bumping along that low end. And as Masrick has talked about, and other shippers, especially when you look at Chinese data and other data that's come out, there's a lot of headwinds when we're looking at exports, imports, and where that's going to go going forward. A bit of a heat wave that's going to close out August. Here you can see that there's some heat coming through. Pretty much most of everything from the Rockies east is going to be above average. Then when you look at to the right, that heat expands up and over the Rockies by way of Idaho. So it'll be a little bit of a support for natural gas. But again, this is kind of that last hurrah. And then when you look at some of the expectations for September, it's going to be a bit warmer, but not to this degree. Some of those above average are going to pare down a bit, and you'll get a little bit of that cooling come through. But this will impact some refining. We've talked about it from the frac spread counts perspective. This is going to impact some of that activity, keeping things a bit pinned. Gasoline stocks drew 260,000 barrels, 15.3 million below the 5-year, just 0.5 above the year on year. Because as we're saying, the rate of change has slowed. We're not getting the same draws. Pad 3 had a build of 1.65. You had some draws around, but remember, Pad 3, you're starting to get a little bit of this increase in refining utilization rates, not so much this past week, but the week before. It's a little bit of slowdown in terms of where exports are going, and that's going to put some of those builds in there. Pad 1 is still 6.7 million below the 5-year. But then you look at blending components. Blending components had a small build of 390,000 barrels, 9.7 million above below the 5-year average, but now 1.2 million above the year on year. And you're starting to get some of that pivot. And we're getting towards the end of summer driving, towards the end of summer grade gasoline, and you should see some of this being pushed into the system, trying to clear it as before we get into winter grade. Gasoline imports slowed down further, came down 98,000 barrels a day. That's 241,000 below the 5-year. We do have a little bit of a pickup coming, but not what we were expecting, because again, there's still so much gasoline in Europe, but rates are expensive, and the ARB, which was there, is gone a bit. Now it's coming back again, so we will see some additional exports coming into the U.S., or I should say imports coming to the U.S., but not to the expectation that we were expecting of getting to about 800 to 850,000 barrels a day. Instead, it's really dropping back down, because we were expecting to be, it'll come back up to about 650, 750, but not back to what we were expecting, which is why we didn't get that spike that we were hoping for in storage, but it's still keeping us fairly flat. And a lot of that is being driven based on additional runs from U.S. refiners, as well as slowing demand. Here's where you can see the blending components starting to curl back up a bit. And as we've been saying, the comps get easier. So there's typically that drop down because you really want to get this into the market prior to the end of summer driving, but we're not getting that. Instead, we're just kind of flatlining. So the comps get easier and we're going to run right into them, so it looks bullish right now, but the bullishness fades very quickly, especially when you look at where we are versus comps and how we're all going to essentially meet in the middle as we get into the middle of September into October. And a lot of that is from that slowdown in driving. Asia Pacific is still below the 2019 levels, but right in line with what our expectations were. Europe had a huge drop. It's now below where it was in 2022. That was not what we were expecting. It's 61.2% of where it was in 2019. North America is 84.7% of where it was in 2019. And remember, we were expecting to be between 90 and 92%, much higher from here. And instead, we're just not getting the same level of activity, the same level of exposure, which is what we're seeing in the Gas Buddy data as well. They were expecting 8.92. EIA came in a little bit below that. Even here, we think it's a little bit higher, but still, we're not getting to where we should be, which is something closer to 9.4, 9.5. And again, we're seeing that across multiple data points because we're just not seeing the level of demand that was expected. And a lot of that has to do with economic pressures. And one of the key ones here is continuous increases in pricing. So last week, we were at $3.82. On national average, here we're at $3.86, and diesel's actually running a bit harder and faster, and a lot of that is driven based on the lack of supply, a little bit of an increase in some of the trucking demand, or at least trucking data in general. But again, you're still seeing those issues that are arising from the pressure points that we continue to see in the market in general, especially when we start looking at gasoline. Now, one of the things, for some reason, it didn't translate over is the CAS data. The CAS data, the CAS index is showing, again, a bit more of a slowdown on the trucking front, but in line with what we've seen. But even with some of those slowdowns, we don't see diesel pricing getting much better. And both of these are also helping to drive a bit of that year-on-year inflation as well as that month-on-month, because it's, July started okay, and then by the second week of July, you start to get this really big gun higher. But August started out high and is getting higher, which is why we do see some of that reacceleration of inflation this month. Here's looking at gasoline demand in comparison, looking at EIA, coming at that 8.85, just below where we were in 2020. Not a very good comp. And obviously, as you can see, we'll get a bounce, because typically at this point we start to bounce around, but we're still well below where that 10-year average, which is what we were expecting to get back to. And instead, we're just going to kind of bounce sideways. We will get one more increase going into Labor Day weekend, but not a huge, and we do expect that to underwhelm as well. Propane had a build of 670,000 barrels, tracking well over the 5-year average. We don't see that changing. Just given the amount of production that is happening and the slowdown in petrochemical demand, which again is still supporting our LPG exports. Jet had a build of 120,000 barrels, just 0.1 over the 5-year average, 1.3 million over the year-over-year. But as you can see, it's just right back in that range. We still see that range being fairly tight, especially when you look at the way departure schedules are tracking. You're starting to get a small slowdown, but as we normally do, just given based on the time of year. And then as we were saying, we've gotten some sizable drops because of these a huge amount of cancellations that have happened. And that is going to result in additional slowdowns in demand based on the way the EIA calculates it, because if you're not flying, then you're not consuming the jet fuel at the airport or on site. So you're going to slow down your orders coming from the blenders because you have to use what's on site. And that's where we're going to see some of that going forward. Then when we look at TSA passengers, 2019 and 2023, almost perfect in the U.S., continuing to be slow in Europe, which again, we don't see changing. Now, we'll talk about this in the econ show, but because we did get a little bit of a love when you look at retail sales on the eating out side, but here you can see it is slowing. Now the U.S. is at 6% on average, below where we were last year. Globally, we were at 1 to 3%. Now we're at 5 to 6%. So things are progressively getting worse, which makes sense when you look at inflation and other types of pain points, and that's where we see some additional issues going forward. Especially showing consumer weakness and the like. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into the global market, especially when we look at crude and refined product flows.